Wow, it has been some time, but I am back, guys, and I have a good one for you today. Not only am I going to break down the very simple three-step options trading strategy that made me 124K this January of 2026, I'm going to show you the exact 42 trades that led to it, as well as go through a few examples that I feel really capture the essence of this strategy. And that strategy is called the wheel. So the best part about this strategy is that no matter if you're rotting away at a desk job or sipping a margarita in Mexico, this strategy will quietly print at minimum a few thousand extra per month in income. In the background, it's over 70% probability and it requires less than 30 minutes of your time per week. Now, I know a few of you are eager to go to the comments and say, oh, well, your account is so large, it can't possibly make anywhere close to 100K a month with this, blah, 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 blah. But don't worry, because in this video, I'm going to show you two different ways to implement the strategy that work on nearly any account size. So if you are new here, my name is John. I did a little over 2 million in profit last year trading option selling strategies like the one I'm about to explain. And yes, you can download my real 1099. In the description, I share and track all my trades live every single day to over 300 qualified traders in my community called Option Lab. You can check it out at optionlab.com. But without further ado, let's break down the three-step 70% plus probability strategy that led to a 124,000 profit month this January of 2026. Let's get into it. All right, guys, we're back on the whiteboard. It feels like it's been a while, but what I'm going to do today is break down very simply the three-step strategy that led to a $124,000 profit in January. I'm going to break down the steps of how to enter this trade, and we're going to go through the actual trades that I track on my spreadsheet here, each one that kind of exemplifies the strategy and show you kind of what stocks I pick and the criteria I use to pick them. So let's just first talk about the actual strategy. So I'm going to go onto a blank sheet here, and we're going to go through very simply the strategy. So the first step of the strategy is going to be selling a cash secured put. So this is going to look something like this. You have a stock, and ideally I'm looking for stocks that are down, right? So I'm looking for stocks that are going to potentially make a move back up. So I'm looking for stocks that have some sort of sharp drop, right? Like we see here. And what I'm going to do is I'm going to do what's called selling to open a cash secured put. So that would be -1. Say this stock is trading right now at 100. So say I use, the 90 put. So I would sell to open one of the 90 puts. And for doing so, for selling that to open that option, I'm going to collect a premium up front. That's money in my account right away. And the criteria for realizing this full profit is going to be that the stock stays above my 90 strike price by expiration. In other words, I collect money for selling to open this put, and as long as the stock stays above 90 by expiration, I keep my premium. Okay, so if that step goes to plan and it stays above 90 by expiration, I don't have to do anything about owning shares or selling covered calls. So step 2 is going to be, step 2 only comes into play if step 1 doesn't work to plan. So step 2 is going to be buying the stock. Okay, so in the example above, let's say, for example, we have our stock and it continues to drop, right? So that 90 strike that I sold to open the put at, the stock ends by expiration below 90, which means now I'm responsible for buying plus 100 shares at 90, right? So now I own 100 shares of this stock at 90, and the beauty of this is I actually kept the premium that I got for selling to open the original put, so that lowers my cost basis of those shares. So step 2, if it goes below my strike by expiration, I'm buying 100 shares at 90. Step 3 is going to be selling a covered call. Okay, so selling a covered call is going to look something like this. We have our stock and it's dropping, right? So it went below 90. So right here's where we got assigned. So I'm just going to write plus 100 shares there at 90. So the reason that I'm picking stocks that are typically having a quick drop is usually these massive overreaction drops are followed by a bit of a recovery move. So if I get the shares on the, steep and quick drop, I can then own the shares at a low cost basis and then ride the price movement back up and then sell covered calls on those shares. So let's see what that would look like. So let's say the stock now starts to move back up over 90. So let's say right now the stock moves up to 105, okay? So now I have shares at 90 with actually a little lower cost basis from the premium I collected. And now what I can do is what's called selling a covered call. So then I would sell -1 of a call at, say, 110, okay? So ideally what would happen here is I now own shares at 90, the stock has moved back up to 105, and I can now sell calls at 110, meaning that if by expiration the stock goes above 110, right? Because this is just the put side, but on the upside, if that stock ends by expiration above 110, I will then get those 100 shares taken away at 110, and I'll own those shares at 90. So basically, and by the way, for selling this call, I collect a premium. So again, I collect another premium here. I collected a premium down here for the cash secured put. So now I'm selling these 100 shares that I got at 90 at 110, meaning I made a 20-point profit on those shares plus the premium from the cash secured put plus the premium from the covered call, okay? So that's a very simple breakdown of what I'm doing here. So now let's actually get into the trades and I'll show you kind of what I did. So the first one here, I broke these out into 2 columns, the cash secured puts and the covered calls. Now, by the way, if you are new here and you want to see all my trades tracked live and alerted each day, you can go to theoptionlab.com. It's in the description and click I want access now, and I'm going to give you this option selling cheat sheet for free. And yeah, you can check it out. It kind of breaks this down very simply, step by step. Okay, so let's look at some of the cash secured puts first, and then we'll move on to the calls. So if you notice here, this is going to be our ticker, our strike price, our expiration, and the premium collected for entering that selling to open that cash secured put. So you can see here, what I'm doing is I'm picking a lot of names that have high volatility. So things like Tesla, things like NVIDIA, HIMS, Adobe, AppLovin, a lot of stocks that are higher priced, but have a lot of volatility because higher volatility means higher option premium. So if you look here, the criteria for picking a stock to sell a cash secured put on is going to be as follows. Typically, I'm looking for the 20 to 30 delta put option strike, meaning that these options, when I sell to open, there's a 70 to 80% probability that by expiration, that stock is going to stay above my strike price. So each time I go in on this, not only is the stock already down, I also have a now 70 to 80% probability that it's not going to go down even further. And if it does, I now own it at an even lower basis. So some of the things that I look for, like I said, is high implied volatility, news or post earnings report. The reason for this, they cause bigger moves and option premium is going to be higher, right? So option premium is going to be higher when IV is higher. Typically, I'm going 7 to 14 days till expiration. This is because I don't want a prolonged exposure to any one stock, and it kind of lets me capture that short-term move effectively. So those are some of the names right here. You can pause and look through them. There's also a 1099 in the description. You can see literally hundreds of these that I did last year. So the next step here is going to be covered calls. These are stocks that I either own from selling a put option in the past or stocks that I just bought outright on a drop and am now riding the wave back up and selling calls on those shares. So things like RH, AppLovin, IONQ, more AppLovin. So you can see like a few stocks, I'm milking a ton of premium on those stocks because I've owned I got the shares on a very, drastic move downward. And now as the stock starts to go up, like for example on AppLovin, I can just continuously write calls on those shares to milk even more premium out of the position, right? So the criteria for selling covered calls, I'm typically selling 1 to 2 strike prices above where I was assigned from step 1 of the wheel. So for example, let's just say AppLovin, you could see here I'm writing like the 530s to 532.5. So say I was assigned the stock originally at 520. Well, if I'm able to sell the shares at 530 or 532.5, I'm then making an over 10-point profit on those shares, not to mention the massive premium that I'm collecting for selling the covered calls. So I'm doing this, not what I wanted. I'm doing this until I lose the shares. In other words, now I own the shares from the assignment of the cash secured put. Now I'm gonna sell calls until I get those shares taken away, and then the wheel starts all over again. So now the shares are gone and I can sell more cash secured puts and restart the wheel. So, this is kind of a little extra thing here that I wanted to make note of. Notice that I'm selling cash secured puts on down industries on down days. And then as that industry or stock recovers, I'm selling covered calls. That's really the MO of this strategy, for me at least. So how do I actually make this account, or how do I make this small account friendly if you don't have hundreds of thousands of dollars to be purchasing stock and, making this really work at scale? So that's going to come with a strategy called a credit spread, more specifically a bull put credit spread. So something like this. Let me just delete this and we'll kind of show you what that is simply. Now I have other videos. I have a full 35 video course at theoptionlab.com if you want to actually learn this in depth. But what we're going to do here is I'm going to show you a very simple example. So say we have this, right? And there's our stock. So typically what I would do is I would sell to open -1 of the 90 put. But in this instance, to make it more small account friendly and not have that risk of having to buy 100 shares of stock, what I can do is I can actually buy a put below it at say the 85 strike. And for this, I'm gonna have to pay out a debit. And then for this right here, I'm gonna collect a credit. And this is what's called a bull put credit spread. I'm gonna end up collecting a net premium because the credit from the put is bigger than the debit that I have to pay out to buy the put below. So I end up collecting a net credit, but the beautiful thing about this is I don't have the exposure of having to buy 100 shares of stock at 90 if the stock goes below. So creates what's considered a limited risk, limited reward situation that can be implemented on almost any account. So I don't want to go too in depth on this exact strategy today, but I do have other videos. And like I said, if you do want to see all my trades tracked live every single day, visit theoptionlab.com. Also, you can download my 1099 in the description if you guys do want to see all my trades tracked totally transparently. But anyway, glad to be back. Hope you guys like this video. Leave a like and subscribe, and I'll see you in the next one.